Hey, good afternoon, everybody. This is Chris Robinson, Rob's Dive Marketing. Lots to talk about today. I did not get a morning um, comment out because it was just swamped. If you saw what was going on with the metals overnight and even some of the grains, I was very, very busy. Just never got a chance to get over here and do a little talk. So, in any event, we'll be back at it on Monday morning as we head into the weekend. This Friday, I've got the weekly changes here real quick. I'll go through them. You got to lead off with the outside markets just being bananas. Yesterday, silver hit 121 and change. It fell today to 75. From that tippy top to the bottom here at 75, that is a 38% pullback. 46 bucks. And God forbid you were long a one lot. That's $46,000. If you were long and that's a micro. If you were along a mini, that's $2,500 a penny. If you were along the big one, that's $5,000 a penny. So 5,000 times 46 bucks. So there's a lot of risk reward there in silver. And at the end of the day, you'd always laugh. People on social media, they're always like, "Oh yeah, we're going here, we're going there." Where are they when their advice, falls through? So I always approach it like bull or bear. Whatever you've got on, you've got to be very, very, very discipline because um, it's not about what happens when you're right. When you're right, you make 46 bucks. When you're wrong, you can just get absolutely destroyed. And even you saw it today when we broke down. We went through 100 bucks. We went to 75. I think people thought we were going to go to 60, 65. You start looking like where we're going to go. And 10 seconds later, we were at $10 higher. So it turns. It doesn't give you a whole lot of time to make adjustments, and none of these markets do, which is why I work with farmers and producers. You don't want to be a day trader trading this stuff. You want to be in a situation where if corn, wheat, or beans gets to your price, and your price is whatever makes you money at this point, and you got to make sure what that level is. Some guys tell me, they don't make money until it's 550 corn. I was like, huh. I have other guys who are like, no, they probably need about 430, 425, depending on what their inputs are. So, we're right there for sure with these corn at 450. No, there's not a lot of meat on the bone. But again, watching the way silver trades, watching the way the beans have traded, when a market gets to your level, you've got to have a system in place or at least a strategy to reward rallies or protect them. Especially if you, as a farmer or producer, you're always bet long. You are a speculator with one arm tied behind your back. So that's why you need to educate yourself on different ways you can manage your risk. At the end of the day, if we knew where the highs and lows were, we wouldn't need to hedge. If we knew where the highs and lows were, there wouldn't be a market, right? So the market, as the market discovers prices, which is what this is, price discovery, it can be vicious. It can be a train wreck. It can be very, very, very upsetting. So that's my 2 cents there. I wanted to talk about crude oil as well too, and diesel. It was weird back when we had the Iranian issue. Crude oil traded like 78 bucks. We broke down to 55 just before Christmas. So we had that big collapse. We were 5-year lows. We really didn't hear much about it on television, but lo and behold, we rallied from 55 bucks to 66, which is ironically the halfway back of that slide. It takes 78 to 55, 66 is halfway back. So it's a reset button, 6-month high, and it brings all of the naysayers and doomsayers out of the closet again, screaming about greedy oil companies. Where were they when we were down at 55 bucks? Awfully quiet. So it's a free market. Market prices move, and we just have to deal with it. We saw the same thing with diesel. Diesel had gone from 271 down to 205, actually got to 210 and then dipped down to 205, which was a 7-month low. And nobody knew that was the low, least of all me. But we did point out to people saying, hey, if you use a lot of diesel, it might not be a bad place here to at least, buy some product or put some hedges on. A hedge at that time would have been cheap calls. When you're at 7-month lows, nobody wants calls. They all want puts. Because when we're going lower, people want that downside protection. It's ironic that the best hedge is usually the opposite of what the market's doing for you. So if you're a producer, you always want to be looking to reward rallies. If you're an end user, i.e., like someone that used a lot of diesel, well, and like I said, when we dropped to 205, and here's the rub: me saying, oh, look, that was so easy. That was a 205 was the low. That's bananas. That's not what I'm saying. I'm saying when the market dropped 25, 30% like that sharply and was at multi-month lows, it's not a bad time for an end user who's somebody who buys it all the time, right? You're short all the time to step in and do some buying. So this is the beginning of 2026. I'm sure we're going to have, we could potentially have a lot more volatility like that. So file it away as a lesson. Try and be a little bit more proactive when the market gives you higher highs or lower lows, and try to take advantage of it as best as you can. For the week, I'm going to do the weeklies real quick. Corn finished down 2.25 cents. Bean finished down 3.5 cents. Wheat, Chicago wheat finished up 8.75 cents. So there's your weekly changes. For the day, kind of ugly Friday. March corn down 2.5 cents on a 7-cent trading range. March beans down 8 cents on a 13-cent trading range. March wheat down 3.5 cents, although for the week it still managed a nice recovery, but an 11-cent range there in the wheat. And not a disastrous day, but certainly was irritating to me from a marketing standpoint. We had been looking at 11.02 as a big retracement. It would have been the 62% retracement of the break from the November high at 11.31. And we bottomed out at 10.55. That's new crop beans I'm talking about. New crop beans dropped 76 cents. If we had hit 11.02, it would have been a 60% recovery. We got to 10.98. So, and then there was some profit taking here because we're heading into the weekend. It's also the last business day of the month, last business day of the week. So, not surprising to see that sell pressure come through. In the livestock, it's interesting. It looked like it was going to go higher yesterday when we poked above those highs. Fat cattle, feeder cattle, and the hogs were all lower today. At one point, it was sharply lower in the feeders and live cattle. We did come off the lows a little bit. Feeder cattle came off the lows by about $2, but had been down, over 6. Lean hogs finished today down 30 cents at 95.15. And April fat cattle finished today down just about 50 cents at 236.80, a high of 239.70. So watching April fats, you got to watch 240 for the March feeders. You've got to watch that 366 area again. Again, 365 had been the big resistance. 366 looked like it was going to open up the door to run up there to those old gaps. I think a lot of people were looking for that. And a little bit of a pullback here. They did come out with the cattle inventory numbers. I think it was already baked in. We'll have to wait and see what happens on Monday. Guys were touting today that the cash market remains strong. But just from a technical standpoint, it looks like this market might be rolling over a little bit. You have to remember, we just rallied $35 off the lows, and fat cattle, 70 plus bucks. I think it was $74 or $75 off the low in feeders. Typically, something like that brings in some correction after the fact. And let's face it, when you hit 3-month highs in the cattle, that's always a blessing, right? So it was an opportunity. Nobody sells the high. It's not all lost. If we did roll over from here, we'd have a really good rally and you'd still be in relatively good position. We'll see what happens next week if we can continue to push higher. In the lean hogs, that was the one contract that was lower on the week. After making new highs, it did make what's called a key reversal. Outside week down, we made a new contract high and then settled lower on the week. And we also had a lower low on the week than last year. So if you run that weekly chart, and this is why I do the weekly charts every weekend. You want a different outlook as opposed to the day-to-day, or if you spend all day watching the 5-minute charts, it's really important that you step aside and look at the longer-term charts. You can see a lot more of the subtleties as opposed to the whipsaws. So make a note of that. April hogs did hit a new contract high at 97 double, fell to a low of 94.67, right, which was a 2-week low, and we did settle lower on the week to a 2-week low settlement. So anyway you cut it, it's still a heck of a rally. 95 cents the last time I checked is a lot better than where we were on the lows at 81. And I'll say this time and time again, a lot of people that are looking for brokers to work with, they'll always point out, well, you can't call the highs, you can't call the lows. Yeah, guess what? Nobody can. I've been doing this for a long, long time, and the people that that can tell you they can buy the highs and they can sell the low. That's easy to do because that's usually someone making an emotional decision. But anybody that tells you they can do that is not true. And I would argue that that's not really a goal of any marketing plan. Your goal should be to get the meat of the move, not try and be Tarzan, at the breakfast bar at your local hot shop saying, yeah, I sold the high. What did you do? Don't let your ego get too tied up in this business. It can be very, very humbling after a while. How do I know? Well, I spent 22 years on the floor of the Board of Trade, traded my own account. I did not have any clients. I just worked my own account. In 2008, 2009, the market really went away. All the business went to the screen. I was in my early 40s at the time, 40, 41, and I realized, oh, things are changing. And at the time, I made the decision to start to work with farmers, ranchers, and ag lenders because I knew that there was a need. People needed help in managing their positions. And after standing in that pit for 22 years, I had thought I had a little bit of credibility in that market. And that's what brought me here. I worked for another firm for 10 years. For the last 7 years, I've been running my own shop here, Robinson Ag Marketing. If you like my analysis, if you want to find out more, robinsonagmarketing.com. I do have a daily letter. Actually, for 2026, I lowered the prices because everybody is under stress here with prices near 5-year lows and in the grains, especially in the wheat and the corn. I charge pretty much typically what anybody in this business does. I charge $50 a month. However, if you wanted the whole year, you can buy the whole year for $449. It used to be $500 a month. I chopped off 15%, so you can buy it at $449 for the whole year. And for the content I provide, it might be something you want to be looked at. I do a daily letter every day. I do daily comments every day. Once a week, I'll do a private client webinar. It's basically like a classroom. I'll dig into a chart and say, what are we talking about? What's support resistance? Why are we looking at this level? Why should you be concerned about this level? Doesn't matter if you're a bull or bear. So if you'd like to learn that, take a look at it. I do it every week. Again, that's only for members. And that's about it. I hope my information helps you. Hope you have a good weekend. Hope you stay warm. It's good to see January behind us. Let's head into February with high hopes, and hopefully we start to get a weather story here in these grain markets, which can help us get a recovery that lasts more than a week or two. This is Chris. Have a good rest of the day.